It's a combination of what you mentioned earlier, which is really the wage numbers. There's no inflation really on the horizon. We've got, 3.2%. But I do agree with Steve's point that it's still a pretty good number. We've had some sort of noise really the last few months in terms of the weather. The hours have been sort of moving around. That gave us a very strong wage number last month, and in March it came back off a little bit. But really, we're running around 3.3%, a lot better than the 2.8 we had last year.
Yeah.
So I think things are moving in the right direction, but the bond market is not concerned about inflation
and
right now.
This goes back to the slack argument. It's going to feed right. We're going to talk about everything that's going on with the Fed, Steve, but this idea that even though we're down at 3.8% on the unemployment rate, we're not running hot right now. If we were running hot, you would see things like wages going up every month and inflation starting to accelerate. And while the wage number is okay, you're not seeing the acceleration at all here. And you saw the labor force participation rate actually dropped a little bit. That broad gauge use rate, 7.6%.
Right.
So we still have a lot of so-called slack.
So I don't want to prematurely jump the gun on the next segment.
Go
but
for it.
Let's follow your metaphor through. Running hot like, say, a rocket ship taking off. We are not running hot like that. Very interesting to hear what Rick talked about. All of the things he talked about were commensurate with a Federal Reserve more likely to stay where it's at, right? The strength in the dollar tells people, hey, you know what? That relative differential in interest rates between the U.S. and Europe is more likely to remain the same than it is for the U.S. to collapse towards Europe. That would be a reason for dollar strength. Slightly higher bond yields, that would be another reason for it. So, yeah, we seem to be okay. By the way, this idea of there's no inflation, which somebody said earlier today, never mind. There is inflation. It's 1.8%. It's at or damn near the Fed's target.
Right, it's just not picking up.
It's just not picking up. There's no acceleration in the rate of growth. The second derivative is not accelerating. This goes against the models,
doesn't it? For years, this idea was the economy is only a 1% or maybe a 2% economy, Omair, and so if you add 200,000 jobs a month, you're supposed to be starting to overheat. That is not happening.
Yeah, it's not happening, but I think I would go back to a great speech by Vice Chair Rich Clarida back in October, where he said, you know what, something new that's happening is productivity growth has actually started picking up in this economy. It used to be around 0.7, it's gone up to almost double that right now. And that, in fact, can help contain the wage gain. So wages are moving up gradually, but the Fed is not concerned about that spilling over next into core inflation.
Try this idea on, right? So the idea that inflation and unemployment are related, the market gets tight, wages go up, you have more money circulating. The idea makes intuitive sense. So what would be the wedge? What's been happening to the profit outlook? Profits have come down. It's not that the Phillips curve may not be working. It's that the wedge between the working of the Phillips curve is that companies are taking it on the chin, not passing along
but inflation's not up that much. There's not much to take on the chin.
Because they're soaking up this excess costs in their profits.
Instead of passing it along. So let's talk about the Fed for a minute. First you had the Stephen Moore nomination to the Fed. Then along comes Herman Cain. Now both of them are in the camp, I believe, of what the president has been saying, which is rates should be lower than they are now. He repeated that this morning. He said as well that, Omair, he actually thinks there should be more quantitative easing instead of quantitative tightening right now. Is there a case to be made because of what we're talking about right now? There's no inflation. If the Fed went too far at the end of the year, that they should dial that back so they don't snuff out the expansion.
I don't think there's a case to be made for cutting rates at this point. I know the president's hammering on that point. I know these two nominees have sort of fallen into line. You've got Larry Kudlow saying the same thing. So there's certainly a wing there, mostly out of the White House, that believes we should cut rates. The Fed is, I think, very much, or at least will try to not pay attention to any of that as much as we want to talk about it all day long. They're going to do the right thing for the economy, which is really just follow the data. And
but that's what I'm saying. Is the data suggesting that they made a policy error at the end of last year with the final two rate hikes?
I think they changed tack partly because of what happened in the market in the last sort of roughly week leading up to Christmas. But yeah, I think to some extent they've realized that was probably a mistake. They didn't need to go at that point. And I think also just the idea that they were going to be rigid in going another 2 times this year. The idea that the balance sheet was on autopilot, that I think was really the sort of disconnect between the Fed and the markets late last year.